So this is a mess, right? I mean, this is a basic financial crisis 2.0, if you will. And what we're seeing here is Credit Suisse, which already was in a tailspin. And if you look at the chart, right, the daily chart, you have JP Morgan Chase, you had Goldman basically trading near multi-year highs just over the last couple months before this recent collapse. But Credit Suisse was nowhere close to that. It was already in a downtrend. It was already at multi-year lows. So what that was telling us is that smart money knew this was the bank that was going to be in trouble. It was going to be one of the big ones to be in trouble first when we got a situation like this. And when you have interest rates rising this dramatically, right? So we're not just talking about, oh, it's, 4 point something on the Fed funds or 5%. We're talking about where it's come from. So it's the velocity of the move that has broken the system. And part of that is the fact that the Federal Reserve basically mismanaged things, right? They said everything was transitory when it came to inflation. They were wrong and had to play catch up. So again, even when we were out of a financial crisis due to COVID, they still said, oh, we're going to still leave it as is, zero interest rates, essentially free money, because we don't want to rock the boat. Well, the end game is they had to play catch up here. And now you're seeing whether it was Signature Bank or SBNY or even Credit Suisse here, these are some major issues. And that's going to be something that the European Union has to deal with now.
Hello and welcome to Money Talks. In today's video, founder and chief market strategist at InTheMoneyStocks.com and Verified Crypto Investing, Gareth Soloway updates about Bitcoin's current market standing, the final bottom in crypto, and his outlook for Bitcoin in 2023.
Yeah, so this is the key, folks, and I'll say this, is I've been nibbling on a few different financials, like a little bit of Goldman Sachs, a little bit of JP Morgan, and I've been buying some ETFs that are spread amongst many of the banks out there. And the reason I'm not touching Credit Suisse is much the reason why it was a bad idea to touch SBNY or Silicon Valley Bank is that you're basically putting your money in one asset that we know is already trouble, and we don't know how bad this is going to get. So my recommendation is go with the best of breeds if you're going to nibble small, or go with an ETF that spreads your risk out across the board. But Credit Suisse, this is one of those things. It's like a Lehman moment potentially, where we could wake up one morning and it's shut down, much like we saw with Lehman Brothers. I do. I don't know how many more seizures will occur, but I do agree with him that inflation is going to remain elevated above that 2% mandate that the Fed has said. I've said this for the last year or so. To get inflation down from 9 or 10% to 5 or 4%, that's the easy one. That's like, you lose 10 pounds at the gym. To get that final six-pack, it's a lot of work, and that's where we are at this point, where, again, it's going to be very tough because, remember, wages skyrocketed. You had companies that were paying $10 an hour that now have to offer $20 or $25 an hour. They weren't able to pass that cost over to consumers day one. So what they're going to do to keep their margins in line and get those margins back is inch that into the consumer's pocketbook, essentially, over multiple years. And that's going to take some time. So you're going to be looking at elevated inflation rates. And again, we have to be ready for something probably around 3 to 3.5% for multiple years to come, which is the scariest thing of all, because now we're in a crisis where normally the Fed could be like, oh, well, let's lower rates to save the day. That can't happen now. They're basically at a point where, yeah, they could pause, but we just saw PCE numbers recently that were sky high. They can't be cutting rates yet.
Bitcoin funds are bleeding coins even as U.S. bank failures fuel expectations of an early Federal Reserve pivot in favor of liquidity easing. Usually, if the Fed doesn't raise rates aggressively like it has been doing, risky assets like Bitcoin benefit, but the opposite is occurring with the Bitcoin funds. Data tracked by ByteTree Asset Management shows the number of coins held by close-ended funds, spot and futures-focused exchange-traded funds in Europe, the U.S., and Canada has declined by 16,560 BTC, $409 million this month, reaching a 17-month low of 826,113 BTC. ETFs and other investment vehicles that allow taking exposure to Bitcoin without having to own the cryptocurrency are widely considered a proxy for institutional activity.
Yeah, so on a chart like Goldman Sachs, I mean, we've now come down just in the last few days from $350 to near $300 a share. I mean, these are banks that may have some exposure, but they're a lot more nimble and bigger than a lot of the regionals out there that are having a lot of trouble. And you have to assume that their management is better too. And I think that's one of the big things here is, yes, it's partially the Fed's fault that you saw these collapses because they raised rates way too fast and these banks weren't prepared for that. But at the same point, their management was way behind the curve to be being paid what these management companies and CEOs are being paid at these banks, and to fumble the ball like this is not acceptable, frankly. And I think they have to be held accountable, not just the Federal Reserve, but Goldman Sachs, JP Morgan, these are best of breed banks. So at least in the near term, I think you play them for a bounce. I'm not saying that, again, this is a buy and hold for the next 5 years, but you're looking at a short-term technical bounce that's probably getting close.
How short-term?
Oh, boy. So, I mean, for me, it's more of a price point. So if we look at the chart here on Goldman Sachs, I would be looking at a bounce back to about $330 to $340, which nets you about 10%. So you look for a 10% snapback over the next couple of weeks to month, and then you kind of step aside and say, okay, let me reevaluate. Because remember, this is the kicker, is that we are going to go into a recession. There's no way around it at this point. I just think it happens in the second half. And then once we go into a recession, then these banks are going to be put under new additional pressure from economic issues. Yeah, so I'm expecting 0 to 25. And again, I think in the next few days, we're going to know whether it's 0 or 25. If things get worse, it's 0. If things calm down, then I think he might do 25. But you had mentioned, too, that the Federal Reserve had telegraphed their rate hikes, right? And it makes it think like, oh, well, how are these banks so dumb to not recognize when he basically said, hey, guys, we're raising X, Y, and Z, so be ready for it. The problem is that in reality, the Fed has almost no trust value, meaning that, where's the credence when, in 2018, they basically reverse ship immediately. They've been basically the drug dealer to the market, just feeding it liquidity constantly over and over again at the littlest issue out there. And so you can't blame people for saying, oh, well, the Fed will just save us if something goes wrong, and starting to believe in that when the Fed has made us believe. And now all of a sudden the Fed's deciding to stand up and cut off the supply. That's my issue there, is with the Fed, is that they're not fully trustworthy in what they say over time.
Bankrupt cryptocurrency exchange FTX transferred $2.2 billion to founder Sam Bankman-Fried through various entities, the firm's new management said. A total of $3.2 billion was paid to Bankman-Fried and other key employees, according to a financial report filed Wednesday. The next largest beneficiary after Bankman-Fried was Nishad Singh, FTX's former director of engineering, who received about $587 million. In February, Singh pleaded guilty to charges including fraud and conspiracy for his role in FTX's collapse. The payments were made predominantly from the Bankman-Fried-owned trading firm Alameda Research, whose precarious finances set the wheels in motion for FTX's collapse in November.
Yes, and so I'm expecting basically 0 to 25 basis points. And again, I would say in between now and that meeting, we're going to know based on if things get worse, it's 0, there's no rate hike. If things calm down, and let's say Europe kind of calms down, Credit Suisse calms down, then I think you're looking at a 25 basis point hike next week. So again, I think that's the angle to take it. And then after that, I honestly don't expect any additional hikes. I think we saw the PPI numbers coming in negative today. That's important to recognize. And again, that's showing us that at least on the producer side, prices are actually starting to drop. And then I think just the action of the instability that this is creating in the financial system, the Fed is going to have to back off and wait and see. They're going to have to take a wait and see approach, which is what they should do. And honestly, they probably should have done a little while ago. Yeah, so I do think inflation comes back down. By end of year, we'll probably be looking at a forward inflation rate of let's say 3.5%, kind of what Larry Fink was saying in his comments this morning. But I think, again, that's a problem, because the Fed is not going to be able to cut rates aggressively unless stuff gets so bad. And, we're looking at the regional banks and what's going on in Europe and saying this is really bad. But this isn't even close to as bad as it has to get before the Fed is willing to actually cut rates if inflation is above 2%. And that, I think, is scary to me because, what does it look like if it gets to that point where the Fed actually has to lower interest rates?
U.S. Securities and Exchange Commission Chairman Gary Gensler is doubling down on his opinion that proof-of-stake tokens could meet the definition of securities under the Howey test, thus bringing them under his agency's regulatory authority. Speaking to reporters after a committee vote on Wednesday, Gensler said securities laws could be triggered because investors anticipate a return when they purchase tokens underpinned by a proof-of-stake consensus mechanism. The block first reported the news.
Yeah, what does that look like, Gareth?
I would say S&P sub 3,000 at minimum. In fact, per the S&P chart here, that's what I'm expecting. So I'm expecting, again, a little bit of a break lower here. We're obviously seeing downside down to basically the pre-COVID highs, which is right around 3,400. That's first stop. We're about 450 points away from that at this point. And then ultimately, I think by year end, we're at 3,000 or sub 3,000 on the S&P 500. So it's going to get worse. And this is the issue, is that, remember, the markets have been conditioned. Investors have been conditioned to say, anytime we hit a hardship, anytime we get into a recession, the Fed will bail us out. The problem is we're going to get into a recession in the second half, and the Fed's hands are going to be handcuffed. They're not going to be able to bail us out like they have done in the past. So if they actually get to the point of cutting, we are probably in such a catastrophic event in the market system, in the economy, that's why they're doing it. So I'm thinking that you're going to have to see like north of 8% unemployment, maybe 10%, before they cut in the next 12 months. And again, I don't know if that unemployment number will happen, but we have to realize that if they start printing money again with inflation at 3.5%, where's the next stop? Is it 15%? Is it 20% before? And so they are realizing this as well. We know that you mentioned this earlier, that Volcker had an issue where he kind of lowered rates too quickly. Jerome Powell says he doesn't want to repeat that. So he's very aware of that issue that could arise. And so he's going to try to hold back as long as possible from cutting, as long as inflation's above that 3% area.
So what are your thoughts about Gareth Soloway's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.